A very good evening to one and all. We are Team Athanasius of Alexandria here to present an investment research report on Petronet LNG. Our recommendation for Petronet is buy with a 12-month target price of INR 206.4. It represents an upside of 35% from the current stock price. The presentation flow will be as follows. First, the business overview, investment rationale, financial analysis, valuation, followed by risk analysis. Petronet operates in the downstream of the LNG value chain involved in unloading and regasification of imported LNG. It currently has one regasification terminal with a capacity of 10 MMTPA at Dahej, Gujarat. It has one long-term supply contract for 25 years for 7.5 MMTPA with RasGas of Qatar. It is constructing an LNG terminal at Kochi with a capacity of 5 MMTPA scheduled to be operational by Q3 FY 2012. It is also exploring the feasibility of developing an LNG terminal on East Coast. It has shown a strong financial performance with a revenue CAGR of 17.4% and stable revenue margins. The key drivers for growth are expected to be its high capacity utilization and improvement in operational efficiency. The key challenges are expected to be its high financial expenses and increasing spot LNG prices, which is currently at $15 per MMBTU.
Moving on to the investment rationale, why should we invest in Petronet LNG? So the first point is the rapidly growing Indian economy has resulted in an increasing energy needs for our country, but our energy supplies have not kept pace with the growing demand. Now in this scenario, natural gas is expected to play a key role in meeting our energy demand in the near future. But the problem is, India's domestic natural gas supply reserves have been depleting very rapidly with a lack of new discoveries and the recent KG-D6 also falling short of expectations. Thus, the natural gas demand-supply deficit as shown in the graph is expected to increase very rapidly to more than 5 times the current value in FY15. So, the only solution here is imported LNG. It is expected to play a crucial role in meeting our natural gas demand-supply deficit in the near future. Globally, if we look at the LNG scenario, due to the recent shale gas findings in USA, the demand for LNG has dipped significantly. So all the major gas producing firms around the world are currently targeting Asia as their key target customer. Now this will be hugely beneficial for gas starving nations like India. Now coming to Petronet, Petronet with its first mover advantage in the imported LNG segment will be the biggest beneficiary of this situation. With terminals located near key markets and access to cheap LNG provided by RasGas Qatar, we expect increasing capacity utilization in both the Dahej and the planned Kochi terminal. And also, Petronet will be able to charge attractive regasification tariffs when compared to its competitors because of low cost. We project a strong financial performance in the next 5 years with an EPS CAGR of 22% and a quadrupling of book value. The return on equity is expected to remain stable over the next 6 years.
Yeah, coming to the financial analysis part of Petronet LNG. Yeah, we can see that Petronet has a revenue CAGR of 21.6% and an EBITDA CAGR of 21.6%. This is basically due to the back-to-back offtake agreements that they have with their customers. This translates into an EPS CAGR of 21.8%, which is higher than the revenue. This is basically due to the lower financial charges during the later part of the forecast period. A major chunk of the earnings are coming in the form of operational cash flow. This is evident in the 21% operating cash flow CAGR that we can see. And the operating cash flow to sales ratio is also constant at around 14%. This indicates that the company is generating sufficient cash flow from the new capacity additions apart from the existing capacity. The present value of the operating cash flow during the forecast period is estimated to be around 8,454 crore INR, of which 50% of the OCF is being plowed back into the business in the form of capital expenditure, and 8% accounts for the change in net working capital. The change in the net financial position also contributes to increasing the free cash flow to equity of the firm. Coming to the balance sheet, we can see that the interest coverage ratio is stable at around 6 and a current ratio of 1.29, which we think is sufficient to meet both the short and long-term obligations of the company. And once the capital expenditure plans are completed, the debt to equity is also expected to approach the management's guidance of around 70%, and the return on equity also stabilize at a level of 25%.
Moving on to valuation now. We have used different valuation methods to value different cash flow streams based on the certainty of the cash flow. For Dahej and Kochi terminals, which have very certain cash flow, we used FCFF and multiples. For the proposed East Coast terminal, which has uncertain cash flows, we have used real option valuation. And for the proposed power plant in Dahej, we have not considered it because we don't see any revenue visibility as of now. Moving on to DCF now, we expect the company would generate positive free cash flows from FY13 onwards. We have used two-stage FCFF model with a terminal growth rate of 2% and WACC of 12.6%, which translates into enterprise value of 16,600 crores. Accounting for net debt, we have equity value of 13,800 crores, which translates into a share price of 184 rupees. Moving on to multiples now, we have used three multiples: price to earnings, price to book, EV by EBITDA, and we have taken four closest peers in the gas sector, that is GAIL, Gujarat Gas, Indraprastha Gas, and GSPL. Based on the mean values, we arrive at a target price of 200 rupees. And also we believe that Petronet LNG is quite unique in its business model, so that it has to be valued with respect to itself. So what we have done is we have taken last 3 years trading PE multiple, that is around 14.68, and using EPS estimate of 13.14 for FY12, we arrive at a share price of 193 rupees. The real option valuation for the proposed East Coast plant, based on our cash flow estimates and equivalent risk-free rate of 8% and variation in cash flow of 20%, we value the real option at 1300 crores, which translates into share price of 18.5 rupees. Our price target, assuming 70% valuation for DCF and 30% for multiple, we have a share price of 187 rupees. Adding on the real option value, we have a target price of 206 rupees. The current market beta is 0.79, but we believe that this beta is not capturing the complete risk. So we have used two-third adjustment rule for beta, and we have increased the beta to 0.92. So this actually brings the target price from 235 to 206.
Moving on to the risk analysis part, we've mapped the occurrence of the various risks, the potential impact on Petronet. We then move on to the key risks that we believe have the maximum impact and most likely to occur. Coming to the risk with having a major impact, as we know that the parent companies have not been faring well of lately, it is unlikely that they would continue the complete cost transfer agreement, and hence they would expose Petronet to the exchange rate risks. We know that the imported LNG as of now and the regasification tariff set by Petronet is not regulated by government. Any regulation in this regard would have a direct impact on Petronet's profitability. As of now, there is no sign of increase in gas from KG-D6 basin till 2014. However, any unexpected increase would decrease the market available for LNG, as gas from KG-D6 is priced much lower than the imported LNG. Coming to the risk having an intermediate impact, as we can see that during the Libyan crisis, the oil price movement was very volatile and touched its peaks. Since most of Petronet's long-term supply contracts are with Middle East, a political unrest in this situation could be detrimental. Petronet is expanding aggressively, and it does not have a lot of sufficient long-term contracts to meet these operations. However, the capacity utilization remains dependent on the successful negotiation of these long-term contracts. To this extent, these two risks have been mitigated by Petronet, as they have diversified to other countries for long-term contracts. LNG as of now enjoys substantial price benefits, because the substitutes like naphtha and fuel oil are priced much higher than LNG, and any reduction in the prices of these substitutes would be detrimental to PNG. In conclusion, we would like, given the risk, we would still like to believe that Petronet possesses huge potential to growth, given its position in the value chain as well as this widening supply-demand gap, and hence we recommend a buy with 35% upside in the with the 1-year time horizon. Thank you.
I have first question. Maybe I'm missing something. But how does a 30% growth in profit, or whatever, 22% CAGR in growth in profit for a 30% ROE company quadruple the book value in 4 years? Mathematically, I'm a bit challenged to get to that.
So the thing is, the EBITDA margins might improve here, and also the capacity utilization is going to improve in the future. And also taking in the new capacities that is going to come in, so this will happen. So there are possibilities this will happen.
So we have actually assumed an increasing capacity utilization considering the natural gas demand supply
That's
deficit.
captured in the profit growth.
Yes.
See, ultimately everything is, right now EPS, let's say 13 rupees or 12 rupees or whatever it is, book value is 40 rupees. How does it go to 160 in 4 or 5 years, mathematically in your model?
You might be having the background for the book value calculations or something.
Okay, you can get back to it, but I could not get the mathematics balanced out.
2-3 things. One is, what is the agreement with Qatar Gas? And specifically with rising LNG prices, till what level will they honor it? Second is, what happens after that agreement is over? Because they already have the capacity and you have built a terminal value, and the terminal value is the value which is the highest in all your calculations.
So the contract with RasGas Qatar was started in 2004, in which RasGas agreed to supply LNG at $2.53 per MMBTU. But considering the increasing spot LNG prices which you've mentioned, now they've agreed to a JCC linked pricing, that is a Japanese crude cocktail linked pricing. But this adjustment will be very linear starting from 2009 to 2015. They are agreeing on a linkage of 14.5%, which will be achieved only by 2015. That is a normal standard which LNG is priced in the world market. So actually this is a great advantage to Petronet LNG, because the contracts which are being negotiated now in the LNG market the suppliers always want a 14.5% linkage to JCC. Petronet now recently negotiated a 1.5 MMTPA long-term supply contract with ExxonMobil in Australia. They agreed for this 14.8%, and the price comes to around $15.8 per MMBTU. But since RasGas is at the current value, RasGas is supplying to them at only $8. This is expected to go to $15 only by 2015. So this will translate into a significant advantage for Petronet LNG.
The other thing is that, oil and gas segment in India is highly regulated. And the other gas companies at best make 14% return if they make that. So for how long will the government allow Petronet to make 30% return? Already GAIL has tied up with a US company to procure alternative gas supplies. So what is your rationale from a longer term perspective on those two factors?
GAIL is tied up for a 3.5 MMTPA supply. It starts from 2017 from Cheniere LLC. But this gas which GAIL gets from Cheniere will be regasified through Petronet LNG. And Petronet LNG will be charging regasification charges for GAIL. Now we were talking about the absence of the long-term supply contracts. This latest news which came out day before yesterday adds significantly to Petronet's value, because now they have a significant portion of their capacity covered by long-term supply contracts. So this will actually turn out to be greatly advantageous for Petronet LNG.
And what about the ROE of 30% being sustained?
So we do agree that actually regulations might come in, but actually we have factored it in our beta. The current market beta is 0.79, which we feel that it is actually very less. So we have actually factored it to 0.92, and we have taken that into account.
But ROEs...
We don't project an ROE to increase rapidly, because we know that 25% is
no,
very...
I'm talking about decrease, not increase.
Yeah, we believe the ROEs will remain stable, and regulation over the next 2-3 years, we factored it only by the beta actually. We have not factored it anywhere else.
So this kind of a business which has the contract when it ends. What is there a rationale not to use perpetual growth? Rather you get to the end of the contract, value the assets and cash then, and if you do that, then your fair value, because a lot of the fair value is in terminal value, may be substantially lesser, right?
The long-term supply contract with RasGas, which actually expires 25 years from now, they have an option of actually extending this contract. With RasGas, they have an option of extending, and they can procure as much as they want based upon the negotiation of the prices. And similarly, the contract with Gazprom, which they're entering into from 2016, it also has an option embedded in the contract for extending this contract if Petronet needs more LNG in case. So we believe that will be taken care actually. So in case if the contracts actually run out, the Petronet will exercise the option and procure more LNG. That was the rationale behind using terminal value.
Thank you.
Can you explain for me why you're using as the investment rationale the attractive regasification tariffs? It looks like these tariffs are increasing.
Petronet was the first LNG terminal. Petronet set up the first LNG regasification terminal in India. It was Dahej back in 2004. Now it was set up with a capex of 34 billion rupees. Now since then, in the last 7 years, the cost of setting up LNG terminals in India has gone up significantly. Now the recently coming up Dabhol terminal or the Ennore terminal or one more terminal which is coming up, the capex has gone up significantly. So these companies will not be able to charge attractive regasification tariffs because they will have to take a dent on their margins in order to compete with Petronet. And Petronet uses a formula of 16% IRR on the capex which they invest, and they charge the regasification tariffs. That was the idea of attractive regasification tariffs.
So it's a bigger negative impact on the competition?
Yeah, the competition is actually at a back foot because Petronet was the first to set up the LNG terminal.
Explain to me how the fortunes of this company will vary depending on the price of crude oil. Can you explain that to me? If it goes down, goes up, what happens to the fortunes of this company?
As of now, Petronet has a complete back-to-back offtake agreements with its customers. So any price increase would be completely passed on to the customers. However, as we've spoken, that this agreement might not last long, given how the parent companies are faring. So in about a year's time or something, when the contract expires, then yes, they would be exposed to the rising oil prices, and most of the contracts which they're negotiating into, that would actually take a hit. But as in a 1 year horizon, we don't see much impact of it because it's completely passed on.
Who's the parent company?
GAIL, IOCL, and BPCL, and ONGC. They all have 12.5% stake, adding up to 50% stake. So GAIL is the parent company, and GAIL is mostly dependent upon Petronet in order to cater to the rapidly expanding transmission pipeline. GAIL has announced a very aggressive expansion plan of 155 MMSCMD to 350 MMSCMD. Now, in order to make gas flow through these pipelines, GAIL is dependent on Petronet LNG very, very badly.
Compared to other gas substitutes like oil, natural gas prices have been very consistent. What analysis have you done from a sensitivity standpoint to allot for a rapidly rising natural gas environment?
What has happened, actually, natural gas, the spot LNG has been trading at around $8 to $9 per MMBTU for the past few years. But due to the recent Japanese earthquake which happened, all the nuclear reactors were taken a hit, and Japan started procuring LNG very much rapidly from the LNG market. Now, this actually shooted up the spot LNG prices to close to $15 per MMBTU. But once Japan's reactors start coming online again, we believe the prices will go back to the standard averages of around $8 to $9 per MMBTU. That's how they have been trading for the past decade or so. There have been no aggressive price increase unless something like a Japan earthquake happens. So from 2 years from now, I believe the prices will be around $10 to $11 at a maximum, not at 15 to 16 which they are trading currently.
And is that impact in your analysis? Is that in your risk-adjusted beta?
The Petronet actually has a long-term supply contract which we mentioned with RasGas Qatar, and they're actually procuring spot-term cargoes, but currently most of their capacity is being used by the long-term supply contracts with RasGas Qatar, and RasGas is actually having an agreement in order to supply to Petronet at a lower price than the current spot LNG prices in the market. So Petronet is at an advantage there also, because any other firm which wants to procure LNG will have to procure at the high spot LNG prices of $15 to $16, while Petronet is enjoying huge benefits by procuring at $8 from RasGas. Yes, they are procuring spot cargoes, but that is for 25% of their capacity. 75% is covered by long-term contracts.
Thank you.
Thank you.